Last week, the S&P 500 ended very strongly right across the board, near all-time highs once again, but there is some cause for concern when we do take a look at the S&P 500 P ratio. Right now, it sits at just under 31. Now, bear in mind, the modern era average does sit around 20, and that is why in today's episode, we want to focus on 3 growth stocks that the smart money institutions have been buying, and the first one is Uber. Now we can see here around 80% ownership. Now they have been selling as well, around 10 billion over the last 12 months. However, during the same time period, we do see a lot more buys, just under 17 billion, and we can also see in the more recent quarter 1.92 billion buys, and the trend has been over the last year that institutions are buying a lot more shares quarter on quarter. Now when we take a look at the performance, well, first thing that does strike to us is that Quant give this a strong buy, as well as seeking alpha in Wall Street with the buy ratings. In fact, we notice Wall Street 4.48 isn't far off the 4.5 that would flip them as well into a strong buy. Right now, it does sit in the midpoint of the 52-week range, the forward PE sitting just under 39, and over the last year, nice performance, up 28%. If you've been a longer term shareholder, you would be up 144%, and you would have outperformed the S&P during this period. Now we just have to look at their latest earnings, which was very strong, to see where this company is going. We do know they had a double beat, whilst the company's revenue is growing at around 20%. Now if you want to take a look at the actual numbers, well, their EPS was phenomenal, $1.20. The market was expecting 41 cents. And when we get to the revenue, another nice beat, 11.19, above the 10.98 that investors were expecting. We do, however, note they did come in slightly under in terms of the gross bookings for the period, 40.97 billion. Analysts wanted 41.25. But one thing that does really strike out to us is that their bottom line is growing at a very rapid rate. Net income of 2.6 billion. Same quarter last year, they reported 221 million. And when we do talk about growth companies, we do like to look at the earnings per share. What are they expecting to grow by over the next few years? Well, with Uber, the case is 41.22%. That is what they anticipate over the next 3 to 5 years, whilst the sector median is coming in at 11.5%. No surprises then why they do get this A+ rating here. We do look forward with companies to see how they're expecting their performances to grow. Now, over the next 4 quarters, we do get a little bit of inconsistency. And when we do look at the last 4, whilst we do see that very large beat that we just mentioned in Q3, they have missed one, thereby giving them a 75% track record. Now, if that gives you faith in management and their historical forecasting accuracy, well, over the next full annual reports, they do anticipate 231 per share, which in turn will lower the forward P to 31.19. We also like to look at the metrics of companies before we do jump into our own valuation, and we really like to focus your attention on the free cash flow, purely as we do believe the earnings is susceptible to manipulation by management through accounting. Now, the free cash flow per share, we actually quite like to see this. Yes, we don't want to see negative, but we do notice improvement on a year-on-year basis. And in 2022, they became free cash flow positive for the first time. And we can also see an increase into 2023, an increase on the trailing 12 month, and another increase anticipated over the next 12. So they are continuing improving. And we also like to see the sales growth at a bare minimum. For the majority of companies, we do say 3 to 4% just to keep up in line with inflation, while Uber double digit for the large part year on year. 83 in 2022, that was a very strong performance, 17 in the more recent year, so we can still see their top line is growing at a very attractive rate. If you do zoom out and go as far back as 2016, where they reported 3.85 billion, you can see that they've nearly tenfolded that to 37.3 in 2023. And on the trailing 12 month, this just gives us a hint that 2024 is going to be another strong year. One thing we don't like with companies is when we analyze their shares outstanding and they issue shares, effectively diluting your position over the longer term. One thing we would say though, if they can continue to outperform the S&P, then you probably would be less worried about the issuance of shares. Typically on this channel, we want to see companies that return excess cash to investor pockets through those share buybacks, something that Uber have not done as of now. ROIC, one of our favorite metrics, we want to see 10% or more. Give us faith, management are able to effectively allocate their capital. Now, it's been negative for quite a number of years. Likely they have been reporting a loss for the majority of them. And in fact, we did see in the more recent quarter a very large bottom line in the billions. 5% in 2023, 9% on a trailing 12 month. So we do get the expectation here that it will start to increase moving forwards, but this is something that we should keep an eye on, as we do want to see, as we said, minimum 10%. Now, operating margin, two things we want to see here. Firstly, above the minimums of 12 to 16%, and secondly, operating efficiency, where we see margins increasing over time. Now, we don't see either of those, but again, one thing that we do like is that from around 2019, they have been improving on their margins, positive in 2023, 6% on a trailing 12 month, and similar with some of the other metrics. We do need to keep our eye on just to ensure they can increase these metrics in a positive manner. Same goes for free cash flow margin, although nice to see 9% in 2023. Minimum we want here is 5%, and again, very good to see the improvement on the trailing 12 month at 15%. The final metric we draw your attention to is the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. And the numbers that you see here are the number of years it would take the company to pay off all of their debt net of cash on hand. And this metric correlates to balance sheet strength. Now, we want to see below 3. We see it decrease from 2022 to 23. Decrease on the trailing 12 month, 0.5 anticipated over the next 12. So that is a very good sign, and we can say that their balance sheet, based on this information, does look to be very strong. Now, we're going to jump into the valuation model for each one of these companies today. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified as these videos drop. Now, the intrinsic value for Uber today at $93 has been derived from the DCF model, and we'll show you how we got to that. We have the free cash flow year on year, average growth around 88%. Now, we've gone for 3 rates today. We're going to go with the 12%, but as you can see, we have a low, medium, and high. Based on the discount rate at 8%, we get the present value of future free cash flows and terminal value. And for the 2024, we do use what management are expecting. We then add these numbers together with the cash, subtract the total debt, get to the equity value, divide by the shares outstanding, and get to our intrinsic value of $93, which right now indicates a 30% upside. As always, though, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, where it is for Uber or any others. But as always, for transparency, we will show you at the 10%, it does come to $82, giving it 14% upside. And for those that believe it should be higher, well, at 14, $106, 47%. Now, we will take the median rate of 12% today, where we always use a margin of safety on this channel. We start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that, in today's episode, we'll buy up to around $84, and then we keep going till it's near the current trading price. And what we can see in today's episode, you aren't quite getting the 25% level yet. That would be around 70, but you're getting between 20 to 25. With Wall Street, very bullish, as we said, not far off a strong buy at all. Quant did give it a strong buy with a buy rating from Seeking Alpha. 31% upside, $94 price target. Give us your thoughts below if you believe 20% MOS and 31% does intrigue you. Maybe you've been buying, maybe it's a hold for you, or for whatever reason you are considering selling. Let us know below. We also want to let you know we have released our latest free weekly article where we run through 2 beaten down stocks with over 30% upside. Now, we release a copy every single Monday morning, so the next one is due tomorrow, where we talk about severely undervalued stocks that deserve your attention, as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away. You will also be able to gain access to a spreadsheet releasing today, in fact, 28 undervalued stocks for the month of December. We talk about each one in quite a bit of detail, as well as the upside that Wall Street themselves see over the next year. And another spreadsheet you can grab right now, in fact also recently released, talking about 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. The next one we're moving on to is e.l.f. Beauty, where 92% institutional ownership currently. We do have around $1 billion worth of sales over the last 12 months, but pretty much triple the amount of buyers during the same time period. And when we do take a look at the more recent quarter and in fact Q2, there are some significant buys by these institutions. They are buying a lot of shares of this company. And when we do take a look, we get a strong buy rating from Wall Street, a buy from Seeking Alpha. However, unlike what we saw in Uber, Quant have moved from a strong buy on that company to a hold for ELF. Now, it is trading towards the lower end of the 52-week range, and this was one that we covered when it was around the $99-$100 mark, where we did believe it was a very strong company. We still do believe that, but right now it is up from around 30% of that position. In terms of the forward PE, well, around 36. Over the last year, up around 9%. If you've been a longer term shareholder, you would be up 680%, massively outperforming the S&P 500. Now, in terms of their earnings, well, just look at that headlines. Their shares soar as cosmetic retailer raises their guidance after posting 40% sales gain, which is incredible. Not only, in fact, increasing their guidance, but also a very large gain to their top line. Now, the CEO says here, not only are we the #1 brand amongst Gen Z by a pretty wide margin, but we're also the most purchased brand amongst Gen Alpha as well as Millennials. Something that's also talked about here is that they are well positioned to weather any increased tariffs that could be imposed once Donald Trump does become president in January next year. In terms of their actual numbers, well, we can see a very strong beat, very similar in fact to what we saw for Uber, 77 cents above the 43 the market anticipated. Revenue looking very good, 300 million versus the 286, and their bottom line was around 19 million for that quarter, although if we do remove one-off items, it becomes 45 million, which as we can see is above the 33 million from what they reported the same quarter last year. And as we said, sales is up 40% when comparing it to the previous year. So lots of good news, and we can see here they have raised both their revenue guidance as well as their earnings per share. In terms of looking at their growth, well, they get an A-. We see 16.3% anticipated over the next 3 to 5 years, but that is significantly higher than the 7.5% that we can get from the sector medium. In terms of moving forwards, well, we get green right across the board. Love to see that. Lots of nice growth anticipated over the next 4 quarters with a 100% historical track record and some very sizable beats on a quarter-by-quarter basis. In terms of moving to March 2026, well, 4.32, so they are expecting some nice growth, which will lower the forward PE to 30. In terms of their metrics, well, the free cash flow per share, we get 1.14 in 2024. Over the next 12 months, this is anticipated to more than double to 256. We get sales growth, which is very impressive if you do look at 2020 at the 6% point. Typically, with companies that grow at a very rapid rate, we do see it start to slow down. The complete opposite with Elf Beauty. In fact, it's only started to increase in the last few years, 77% in 2024. And even on a trailing 12-month, that does look very attractive at 59%. And if you want to see it from a numerical basis, well, they pretty much increased their top line 5-fold over the last 10 years. Similar to Uber, they would have also diluted your position over the last 10 years, but you can also argue if they're outperforming the S&P, you really don't care. ROIC, well, better than Uber in terms of the numbers and positive consistently. Nice to see double digits over the last 2 years and 12% on a trailing 12-month basis. Margins a little bit inconsistent. Some years it does straddle around the 12% that we want to see, 15 in 2024, and you could argue from the lows of 2021 it has started to increase. Probably something we would say keep an eye on, but you know what we want to see here, those efficiencies as well as a minimum on a consistent basis. That inconsistency also applies when we do look at the free cash flow margin, but some years are very good. 6% in 2024 is okay, above that 5% minimum threshold. We do love to see this decreasing on the net debt to EBITDA, 3.99 in 2015, down to 0.75 in 24, and anticipated to come down lower over the next 12 months, so their balance sheet does look to be strong. We then get to our valuation at $153. When we take a look at the DCF model, we have the free cash flow as we mentioned. Now our growth rate, we have 20, 25 and 30%. With the 25%, it does give us $153 with around 18% upside, and you can see the different growth rates giving those different values. In terms of the intrinsic value, well, $153, when we do put that at a 10% margin of safety, we get a buy at 137, at 15% around 130, which is where this company sits right now. So we see 15% MOS, Wall Street themselves $160 with 24% upside. Is this one you are considering to buy? Maybe in fact you bought it towards its 52-week lows, or for whatever reason you don't feel like this fits your portfolio, do let us know below. And for those that are interested, at the 20% mark, a buy at 122, at 25 around 115, and at 30 around 107. So 15% MOS and 24% upside. We then move on to NU, where we can see 81% ownership, around 5 billion worth of sales, but again significantly more buys at 7.3 billion. And when we do take a look at that more recent quarter, 2.27 billion, significantly higher than the amount sold. When we look at their performance over the last year, up 54%, very strong performance. In terms of the range, we're currently around the midpoint of the 52-week. We get a double buy from Seeking Alpha and Wall Street with a hold from Quant, and in terms of the forward PE, it does sit just below 31. We then take a look at their more recent earnings. As we can see, their top line is up 56% on a year-on-year basis. Their gross profit is up 67%. This is a lot of growth in this company. We do like to see their margins as well as their bottom lines, but one thing that Wall Street will typically look at is their customer base, just under 110 million, which is up 23% on a year-on-year basis. Now, there are other metrics here that Wall Street will like to keep their eye on if you do want to know, but they are very positive. The majority of them, as we can see, are up considerably, and this is typically what we want to see from growth companies. And in terms of their earnings growth, we can see around 29%, and in fact their revenue is forecasted to grow around 44.6% per year. In terms of looking at their earnings just over the next 4 quarters, well, double digit every single one of them, and at a bare minimum over the last 4 quarters, they have either been in line or beat, so we would classify that as a 100% track record, with a very large increase to their EPS over the next full year, massively lowering that forward P to 21.69. We then get to their metrics. Now, free cash flow, it has been a little bit inconsistent, but nice to see the growth from 2022 to 2023, and from 2023 to the trailing 12 month, that does look very positive in terms of the movement. Sales growth, we can see nearly triple digit every single year, even on the trailing 12 month at 73%. That is a very good sign. Growth is expected to continue, and you only have to look at the movement from the last few years to reinforce that. 150 million top line 2018, 3.71 billion in 2023. Shares outstanding, though, pretty similar in a lot of growth companies that we do analyze. They have diluted your position over the last few years. We then move on to the ROE, where we want to see a minimum of 10%, and we get very positive in 2023, even better on the trailing 12 month. So we do like the way this company is moving. Their metrics, at least over the last few years, have started to become very, very strong. We then move into the valuation model, where we're only looking at Graham's valuation for this company today. The reason is, firstly, they don't pay a dividend, so we would be unable to use this model. We don't use a DCF calculation for companies in this sector, and in terms of the multiples right now, it does trade significantly higher than others in the industry, and therefore it would skew this. But if you are someone that does want to take a look, we can see the sector median sits around 14.93, 14.1, whether you look at the trailing to a month or the forward basis, telling us that it does trade at a massive premium to the overall sector. Now, you could argue it is worth it or it isn't. That is something to consider, but that's why we're not using that one today, and that just leaves Graham's valuation, where we have the earnings per share estimated on average over the next 12 months. We have the growth rate moving forwards, the AAA corporate bond yield, to give us our value of $16.58, with the market price currently under $13. Now, as we said, we will use that margin of safety, and when we do run it at the 10%, a buy at around $15, at 20% around $13.27, and then when we look at the 25%, pretty much where we see it right now, with Wall Street very, very bullish. In fact, the most upside out of those companies we did review today, 38%, they see a price target of $17.50 over the next year. As always, though, do give us your thoughts about these 3 companies today. We had Uber, we had Elf Beauty, as well as NU Holdings, whether you're buying any, holding, or in fact looking to sell. If you enjoyed the episode, as always, smash that like button, hit that subscribe and bell button so you are notified as these videos drop. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets, and as always, come and join us in the Patreon, where we do talk about our weekly buys and sells. Have a great day, and we'll see you all on the next one.